The final part of question 3 requires us to do an income statement, and we've got all the information about a business budgeting for 2023. We're told the total sales. We've got all these account balances. Now these are for a balance sheet. That's where account balances go. And you go, well, we don't need those for the income statement, but we better talk about them before we move on. And we've also got all our additional information, and that's where the guts of all our income statement information will come from. So with the income statement, we're doing revenues earned less expenses incurred, and yeah, most of those things will be in here, and these sales, and you can kind of overlook this bit here. So before we move on, why don't we just look at it and go, these are account balances. However, some of them directly relate to revenues and expenses. We always want to check our question for that. So for example, prepaid advertising, whilst that is an asset, it will be related to advertising expense. So when I do advertising expense, I'm going to need to factor this information in. Then we've got accrued wages, which is a liability, but it will directly relate to the wages expense figure. So I better factor that in when I do that one. And lastly, I've got the allowance for doubtful debts. Well, that will be related to my bad debts expense. So this is our allowance for people that we think might be unable to pay their account, and that will be related to the bad debts expense that we need to declare. So before we actually start, we just want to be aware that when we do get to these points, we better factor that in. But as always, the way to answer this question is just to let you know your sections, and then you find the info, I think is the best way. So working from top to bottom. And that way, instead of all this information that can leave you overwhelmed and you look at it and you go, I don't know where to start, well, you don't even look at the information. Start your income statement and then go and find the info. So we know the first section in an income statement is the revenue section. So we just go through our info from top to bottom, and the first thing we had was total sales. Now, we were also told, though, if we just go through our information, if we look through it, that here it says 70% of the firm's sales are cash and the remainder on credit. So the reason they've given us that is because obviously that must mean they like to split that into cash and credit. So we want relevance in our reporting for decision making. We would really like to know which sales are cash and which are credit. Obviously cash sales are better. We get the money straight away. So what we're going to do is go 70% of 250,000. And that must mean 30% is credit sales of 250,000, and we're going to put that there. And we'll have our cash sales of 175, our credit sales of 75,000, and that's a total of 250, which matches our total there. So now there is all this info here, but don't sort of pick at it. Just go, what's the next section in my income statement? That would be, well, actually there could be sales returns. So before we do that, we should probably look, are there sales returns? And in this case, there actually aren't. There's some purchase returns. But you always want to look for that. Look for sales returns, start there, and there aren't any, and that's okay, we just move on. So the next section, and it's really important you know these sections, so go back to your notes when we did in Unit 3, we did the sections of the income statement, is the cost of goods sold. These are all expenses required to bring inventory in a condition and location ready for sale. And the one that will always be there is cost of sales. You can't have these sales here without cost of sales. And in this case, I can't see the reference to cost of sales there anywhere, nor anything that would help me calculate it. And that is because we actually had to figure that out in an earlier question, and that's the point of doing those earlier ledger reconstructions. So in this case, earlier on, we had to reconstruct the inventory account. And the reason we did that was we had to solve for X. And in this case, X was, what was the total cost of sales? So we figured that out earlier, 64,727. So that will be the number I put here for cost of sales. What's really important is maybe you didn't get this early bit right. You got a different number. Let's say you got 70,000. And that's going to hurt you earlier on with the marking. But as long as you transfer 70,000 from here to here, this answer in the income statement is now right, and you get the mark. So that is cost of sales, but we also need to look for any other expenses required to get inventory in a condition and location ready for sale. So I've got payments to accounts payable, no. Advertising, no. Wages, no. Drawings aren't an expense. That's buying an asset, so no. And this one, cartage and woods. Getting the inventory delivered to us is a cost of goods sold, so that will go in there. We've got our cleaning expenses, no. Depreciation, no. Loan repayments, purchase returns, no. That's a non-current asset. Laptops, inventory loss is separate. bad debts, discount expense, and a loan? No, so we're done. So I'm going to total those two figures up. So we use our first column for our numbers, our second column for our totals. And that will give me, if we remember our income statement sections, revenues less cost of goods sold is what we call gross profit. And it's just the difference between 250,000 and 68,727. So now we need to focus on what's the next section to look for. And that would be, are there any inventory losses or inventory gains? And in this case, it says here, if we just scroll through our info, inventory loss is estimated at 2% of total sales, excluding GST. So that would be 2% of 250,000. So we're going to put this here. Now I put it in the second column. I usually put the item in the first column. The only reason I did that is because it's the only item in its section. And if you put it in the first column, that's okay too. It doesn't matter. And that will give me what's called an adjusted gross profit, which is 181,273 less $5,000 inventory loss will be the adjusted gross profit. So while we're talking about columns, remember, don't stress about the columns. It really doesn't matter. No one's losing marks on the exam. Having marked the exam, I can promise you, if you get this in the wrong column, this one there, or maybe you put the adjusted gross profit there, that's okay. The fact that you've got the correct number is what's important. Now, the next section we want to look for are potentially other revenues. So we go through that. So we're looking for discount revenues or interest revenues. And if we go through this information, we can see we've got a discount expense, so that's a different thing. So we're looking for discount revenue, and the other one, there is a reference to interest that says here, the loan repayments plus interest. No, that's interest expense, not interest revenue. So there are no other revenues. And that means we finish with our final section, which we write less other expenses. So that is all other expenses required to operate the business, and we just make our way through the list. We've got payments to accounts payable is not an expense, it's paying a liability. And now, the first one, advertising, that is one where we go, better be careful because there was some information earlier about that. And it was to do with this. It says prepaid at the 1st of January, which is the beginning of our budget period, it's 3,000. And then we expect it to be 1,500 at the end of the budget period, which is the end of 2023, at the end of December. So I guess what I'm thinking is, do I just put advertising here as 34,000? We don't. What we want to do is just realize, so if this figure here at the beginning of the period is 3,000, that is an expense for 2023, and it was prepaid in the prior period, which in this case is 2022. So the advertising expense is at least 3,000. Now, we're also going to pay 34,000 this year. So that must mean if you go 3,000 prepaid last year, 34,000 paid this year, that's a total of 37. So should we go here and write advertising 37,000? Not quite, because what we need to factor in is when we made these payments of 34,000, we also prepaid this bit for the future. We prepaid 1,500 for next period, which would be 2024. So I better take that out. So now if I do 37,000 less 1,500, I'm going to get a total of 35,500. That is my total expense. So that is the figure I'm going to write for advertising expense here. And that's why it's good when we get those account balances to red flag the ones that even though prepaid advertising is actually an asset, that doesn't go in here. However, it is related to advertising, which is an expense, and that's how we got our total of 35,500. Next one, we've got our wages paid of 4,500. Again, this is one we red flagged and said there was some info about accrued wages. Now, I'm not going to go through it now just because I think it was part C. We actually had to recreate the wages ledger. Why did we have to do that? So we can use it now. So we've already done this. You could calculate it all again and step through it. If you want to go refresh on what we did, go and watch the video for part C. But we said here the total expense that will close the profit and loss summary is 45,800, so that's going to go there. Now again, if you got this wrong earlier, like you got 47,000 here, for example, that's, you lose a mark when you do this ledger, but you make sure you carry forward the number you got, and then you're going to be right here. So the next thing we're up to is we're looking for, well, that's payments to accounts payable. No, drawings. Drawings is not an expense. It sort of looks like an expense. It decreases an asset and it decreases owner's equity, but it is not an expense, so we can ignore that one. Buying inventory, that is an asset when we buy inventory. It's only an expense when we sell it, and we can see we've already got that here for cost of sales, so we can ignore it. But we do have this one. So cleaning expense, that will be an other expense. We've also got depreciation. Now, when we did our cash flow statement, we ignored this because depreciation is an expense, but it's not cash. But because we're doing the income statement, we put it in here for other expenses. A loan repayment on its own is not an expense. It is paying back a liability. However, it says here, there's also $2,000 of interest, and that is an expense. So that will go here is $2,000 as another expense. A purchase return, kind of, is that an expense? It's got return in it and purchase. No, that is just returning inventory back to our supplier or an account payable for a credit. That is not an expense. Buying laptops. Now, that is, we've spent money, so why is that not an expense? That's because these laptops, presumably, we can assume laptops will last for multiple periods. That will be what we call a non-current asset. And the expense associated with that will actually be already incorporated here in this depreciation figure, so we can ignore this too. And now we've got the trickiest one. So this one we need to go back to our earlier topic on the allowance for doubtful debts. So if you need to go back to your notes for that, have a look, because this is brutal. It says bad debts declared will be $1,540 including GST. What does that mean? Well, when we started this question, we said this might be one we need a red flag with the allowance for doubtful debts. So what is this about? It says here on the 1st of January, I've got this pool of funds for $900, and it's just an allowance for people I think might go bankrupt and not pay me back. And I think there'll be $900 worth of people. But it says here during the year, I actually expect the bad debts declared will be $1,540 including GST. Now, a bad debt, we take the GST out. So I'm going to take GST out of $1,540. So I do that by dividing 1.1, and that'll be $1,400. So what just happened? Well, I thought people would be, the amount of people that would go bankrupt and not pay me back was 900, but I got that guess really wrong, because it turns out there's going to be $1,400 of people declared bankrupt. So I got that wrong, but that's okay. The important thing is that we had our guess with this tank or this pool of funds called allowance for doubtful debt, and we just say, look, the balance now is negative 500. So we're left with a negative balance in our allowance for doubtful debts. But this bit here says you should top that back up to $2,200 by the end of the year. So I've got to get it, and that will be my bad debts expense. And that means I need to get it from negative 500 to $2,200. So how would I do that? I would need to make a bad debt adjustment, a balance day adjustment called bad debts for $2,700. So then if we go negative 500 plus $2,700, that will get me to my final balance here of $2,200. So my bad debt expense is $2,700. It's very easy to look at this and go, well, isn't it just $1,400? It's not. That's the bad debt declared just comes out of the tank. It's the actual adjustment that we need to top the tank back up that is our expense. So that is by far, in my opinion, the hardest mark in this question and in the whole course, allowance for doubtful debts. Now, the next thing is we've got a discount expense to be 3% of credit sales plus GST. So credit sales is $75,000. I should add some GST on that, so that's $7,500. That comes to $82,500. So we want 3% of that number, and if we put that into our calculator, we'll get $2,475. And that just leaves the final loan. Well, a loan is not a revenue or an expense, so we can ignore that one. And all we've got to do now is total up all our other expenses here and put the total there. But again, don't stress if you get the columns wrong and put it underneath, it's no big deal. And that will give us a final net profit, which is our adjusted gross profit of $176,273 minus total other expenses of $108,475, gives us a net profit of $67,798. So the important thing here is that I think when you do these reports is you go section by section, know your income statement sections, and then go and find the information. It's very hard to go through this and plonk this in as you go because you don't know how many lines you'll need. So just go, what's the first section? Revenues, and then go and find the info. What's the next section? Cost of goods sold. Go and find the info, and so on. So how did I allocate the marks for this one? So we had 8 marks. So I went 1 mark for the cash sales, credit sales, and total sales. 1 mark for cost of sales and cartage inwards, giving us a total cost of goods sold and a gross profit. 1 mark for the inventory loss and therefore the adjusted gross profit. And then 1 mark for advertising. I thought that was very difficult, so 1 mark on its own. And likewise for wages. However, that did become a carry forward mark, but I thought it's pretty fair to have 1 mark for that. What doesn't really seem fair is 1 mark for these 4 expenses here, particularly this discount expense. And the only and that's because it required a calculation, but the only reason I put it that with these ones is because it was actually something we figured out when we did part B for it, when we recreated accounts receivable. So technically we already had that answer. And then 1 mark for the hardest mark on the paper, this one here for bad debts. Finishing with 1 mark for adding up all the other expenses and then giving us our final net profit.